Very good evening, all of you. In the next 18 minutes, I'm going to make you realize that getting rich is much easier than what you think. And since we are going to talk about being rich in financial terms, we are going to talk about investments. Now, in a country like India, when you talk about investments, you talk about housing, you talk about gold, insurance, PPF, but you hardly talk about investing in stock market. And there are two main reasons for that. One, we believe that investing in stock market is very risky. Two, we think that the skill required and knowledge required to invest in stock markets is very high. I'm going to make you realize in this next 18 minutes that it is nearly impossible to lose money in stock markets. It is nearly impossible to lose money in stock markets. And the skill required and knowledge required to make money in stock markets is nearly zero. So let's start. In India, there are two major stock exchanges, NSE and BSE. Bombay Stock Exchange has a very well-known popular index known as Sensex, made up of top 30 companies of India, decided on the basis of market capitalization, so or market value of a company. So you calculate market value of each and every company in India, and then you start ranking these companies based on market capitalization. The number one company these days is TCS, number two Reliance, and the list goes on. But these companies keep on changing. Even the ranks change, and even the companies keep on changing. But the Sensex continues to go high. Because companies which are not doing well, their weightage in the index keeps on going lower, and they are replaced by relatively better performing companies. So Sensex is basically a dynamic basket of top 30 companies of India, which keeps on changing as and when the economy grows and the new leaders come in the picture. Now, similarly, National Stock Exchange has a very popular index known as Nifty, made up of top 50 companies of India, again decided on the basis of market capitalization. Again, when you calculate the top 30 companies of India in Sensex and top 30 in Nifty, the first 30 companies are going to be same. And the last 20 companies in Nifty are relatively very small, so they don't have a huge impact on the index. So all I'm trying to say is, both movement of Sensex and Nifty, both in the short term as well as long term, is nearly going to be same. If Sensex goes up by 1%, Nifty also goes up by 1%. So in this session, whenever we say Sensex or Nifty, it is one and the same thing. Now, before we start talking about how a know-nothing investor, because this session is going to be about how does a know-nothing investor invest in stock markets. Now, the easiest thing that a know-nothing investor can do for himself is bet in the economy of the country. Now, when I say economy of the country, let us try to understand what do we mean. Now, basically, when we say the GDP of the country, everybody has heard about GDP, gross domestic product. So how do you define GDP? So GDP basically is final value of all goods and services produced in the borders of the country. It is very close to value of goods and services consumed in the borders of the country. So India's GDP is about $2.6 trillion. Now, it means we Indians have consumed goods and services or produced goods and services worth $2.6 trillion. Now, most of the people think, when does Sensex and Nifty go higher? So a lot of people come to us and say, why do we need Sensex and Nifty? So the reason why we have Sensex and Nifty is we believe that it is not only the barometer for the stock market, it is actually a barometer of your and my life. It is a reflection of how well an average Indian is doing in life. And let us try to understand how. Let us assume there are 500 people in this room. None of you have invested in stock markets, but all of you have a Bharti Airtel mobile connection. If all of you have a Bharti Airtel mobile connection, you pay a monthly rental to Bharti Airtel, which increases the revenue of the company, which in turn might increase the profit of the company, which in turn might increase the share price. And Bharti Airtel being a part of both Sensex and Nifty, if share price of Bharti Airtel increases, Sensex and Nifty also goes higher. It means Sensex and Nifty does not go higher when you and I invest in stock markets. Sensex and Nifty goes higher when you and I as consumers buy more mobile connection from Bharti Airtel. When you and I as consumers buy more houses from DLF and more cars from Maruti. When you and I buy more, the revenue, profit, share price of these top 30, 50 companies goes higher. Now GDP is also, like we said, is basically value of goods and services consumed by the country. Now as the next generation keeps on living a better life, we keep on saying the next generation always leads a better life than the previous generation. It basically means materialistically the next generation is able to buy more cars, more houses, more travel, more vacation. As and when the next generation consumes more, the top 50 companies will be able to buy, will be able to sell more profit, higher share price, and Sensex and Nifty will also be higher. Now, to give you an idea, Sensex today is trading at 38,000. When it started, the base value of Sensex is taken as 100 as on 1st April 1979. It has gone up by 380 times in last 39 years. If any one of you wanted to make 380 times return in last 39 years, all you had to do was buy Sensex and Nifty and forget it for a long period of time. 380 times return was the birthright of every Indian citizen. If a farmer feels that he is not able to participate in the Indian growth story, we need to explain him that if he feels that he is not being able to participate in India's growth story, he just needs to get along with the best industrialist of the country. And for doing that, he can just buy Sensex and Nifty and hold it for a long period of time. 380 times in 39 years, if you would have decided not to participate in Sensex and would have decided to keep your money in the bank in the last 39 years, considering the rate of return as 10% after tax in bank, in 39 years, your money in the bank would have gone up by 41 times. Money in the bank would have gone up by 41 times. Sensex has gone up by 380 times. Now, what we need to understand here is that anything that gives you higher return than the bank rate has to come with a certain amount of risk. Now, there are two types of risk. One is the risk of losing 100% of your capital, which is whatever you invest, it goes down to zero. But can Sensex ever go to zero? No. Since it's a basket of top 30 companies, even in case of a war, some company would be actually manufacturing guns. So Sensex can never go down to zero. But Sensex still gives you higher return than the bank rate. It has to come with a certain amount of risk. And what is that risk? That risk is the risk of volatility or uncertainty. What do you think? How has the journey of Sensex been in last 39 years? It has not been a straight line. It has been very volatile. And can we take uncertainty out of stock markets or uncertainty of Sensex and Nifty? Not at all. Because Warren Buffett keeps on saying, Sensex and Nifty or stock markets give you higher return only because they're uncertain. Now, what is the best way to deal with such uncertainty? One way is you invest for a very, very long period of time, which is say 30, 40, 50 years, buy something and don't worry about the volatility. And even if there are phases of 10 years where you don't make any money, but if you're holding it for 60 years, that will be covered somehow. Or the other way is to participate in this growth story through SIP, which is systematic investment plan. But where do you make that SIP investment? So if you keep on investing a fixed amount of money for a very long period of time in Sensex and Nifty, even if Sensex Nifty goes down, you should be happier about it. Why? Because now you will be able to buy more and the average buying price, your average buying price will go lower. And finally, when the Sensex Nifty goes higher, you are going to make money. So which is known as rupee cost averaging. Now, looking at this chart, which says from 100 to 39,000 with volatility, three questions that might come to your mind are, one, how do I buy Sensex and Nifty? Two, what is the guarantee that these kind of returns will be replicated in future? Three, how is buying Sensex and Nifty enough to make me very rich? Now, the easiest question first. Can Sensex and Nifty, buying Sensex and Nifty make me very rich? Now, what do you mean by rich? So, to answer this question, the first thing that you need to understand is, what is the rate of return that you require to become horribly rich or the Warren Buffett kind of rich? If you want to become Warren Buffett kind of rich, the answer lies in the letters to shareholders. If you open the letters to shareholders, the most recent letter to shareholders, you can see his annual return every single year. And what is very important to note here is, Warren Buffett's annual returns are not out of the world. These are not phenomenally high numbers. And these numbers have been very volatile. For the first year, Warren Buffett in 1965 was up by 49.5%, then he was down by 3.5%, and in fact, somewhere in between, which is 1975, God of investing himself was down by 48.5%. It means he could not take out uncertainty out of investing. But what is astonishing is, if somebody would have participated in Warren Buffett's, if somebody would have invested with Warren Buffett from 1964 till today, the overall gain, if you can read the last line, the overall gain that Warren Buffett has made in so many years is around 2.4 million%. What is even more astonishing is to make 2.4 million%, the line above it, the compounded annual gain for Warren Buffett is 20.9%. It means to become rich, to become Warren Buffett kind of rich, 20.9% is good enough. That's why Warren Buffett keeps on saying and reminding that Einstein kept on saying that compounding is the eighth wonder of the world. One who understands it, earns it. One who doesn't, pays it. To become Warren Buffett kind of rich, you need 20.9%. But to recreate that Warren Buffett magic in India, you might have to take into consideration the rupee depreciation as well. Considering that rupee depreciates by about 4 to 5% every year on an average, it basically means to get 20.9% in dollar terms, in India you might have to make somewhere around 26% per annum. So if you can make 26% per annum compounded for a long period of time, there is a very high probability that you will finally end up being Warren Buffett kind of rich. But what is the rate of return of Sensex? Sensex started at 100 and today it is trading at 38,000. In 39 years, if you calculate the CAGR, which is the compounded annual growth rate for Sensex, the CAGR for Sensex is around 17 to 18% per annum compounded. Now, can you become Warren Buffett kind of rich when you invest in Sensex and Nifty? Maybe not. But if you can get 17-18% compounded for a very long period of time, you can definitely become extremely rich. Now, the next question is, before we get into the other part, the next question is, what is the guarantee? Because this is the past performance, and past performance does not guarantee future performance. What is the guarantee that these kind of returns will be replicated in future? So let us try to understand how does the bank work. When you and I make a fixed deposit in a bank, wherein you get a return of say 7%, it is kind of bank borrowing money from you at 7% because you have made an FD that gives you 7% per annum. So bank has borrowed money from you indirectly and is actually paying you 7% for that money. How does the bank make money? Bank basically takes that money at 7% and lends it further to people like you and me and to the big industrialists at what rate? 10, 11, 12%. If the industry borrows money at 10, 11, 12%, their rate of return of the business should be considerably higher than the borrowing rate. But there can be an argument that there are many companies which have collapsed, which have defaulted on their loans, which have gone bankrupt. Now let us assume that all the companies in Nifty go bankrupt. If today all the companies in Nifty go bankrupt and everybody defaults on your loan, what do you think? Are your FDs safe in the bank? We keep on saying your money in the bank is safe only if the industry's rate of returns is more than the borrowing, is more than the bank rate. So the idea is, and there are three forces that will make sure that the industries, the overall industries, which is the Sensex, the overall industry's return will always be more than the bank rate. There are three forces that are working for it. One, the entrepreneur himself. Two, the RBI. If industries are not doing well, the RBI will come into picture, reduce interest rates, and because interest rates will be lower, then the interest burden on the industries will go lower, and people will be able to buy more. Because of that, companies will be able to sell more. That basically means companies will come out of the debt problem. Even if the lowering of interest rate doesn't help, then after RBI, government comes into picture. And government start giving free land to industries, tax subsidies, or n number of decisions will be taken so that the industry's rate of return should always be more than the bank rate. Because the industries create jobs, and if they make more than the bank rate, your money in the bank is safe. Now let us look at the practical part of whatever we have learned so far. So the practical part should be something like this. Let us first talk about a 20-year-old person. A 20-year-old person like you who wants to plan for his retirement, which is say 40 years from now, if he decides to earn by working in cafe coffee day or barista or taking tuitions or any other way, or he decides to save 50,000 rupees by sacrificing a trip to Goa or sacrificing an iPhone, and if he decides to save that 50,000 rupees once, invest this today for 40 years and compounded, if that money compounds at 18% per annum, if that money compounds at 18% per annum for 40 years, that money would become 3.75 crores. To make 3.75 crores by the time you are 60, if you are 20 today, all you need to do is invest 50,000 today once. And if you want 37.5 crores by the time you retire, all you have to do is start investing with 5 lakh today. Now let us talk about a family which has recently blessed by a baby boy or a baby girl. If the family decides to save 50,000 rupees for the kid's retirement, which is going to happen after 60 years, if they decide to do that, 50,000 invested once, 50,000 invested once for 60 years, compounded at 18% per annum, will become 102 crores, 102 crores. So I remember, I keep on telling this in every seminar, that mine is a love marriage. Me and my wife were from the same school. I kept on telling her that I want to get married to you. She kept on rejecting for years. She kept on saying you are weird. Finally, I didn't have a way. I took my laptop, told her this is how you make 102 crores. And she said, yes, I want to marry you. And finally, I got married. But after we got married, she realized that 100 crores, the value of 100 crores would have diminished by n number of times because of inflation. Now, considering RBI guidelines that inflation keeps on increasing by 6% every year for say next 60 years. If inflation keeps on increasing by 6% every year for 60 years, inflation will go up by 32.98 times. The kid, after 60 years, is going to have 102 crores, but his buying power will go down by 32.98 times. Which is, he is going to feel with 100 crores as rich as you feel with around 3 crores in today's value. But that's quite decent. By just investing 50,000 rupees for your kid today, compounded at 18%, you get today's 3 crores. That times 100 crores, but today's 3 crores. Now, one last way in which you can also participate. Say, when you start working, you all have an ability to save money every month and start investing. If a 20-year-old person starts saving 500 rupees every month, for next 40 years, by the time he retires, 500 rupees invested once at 18% compounded monthly, 18% compounded monthly, 500 rupees every month, that would become somewhere around 4 crores. That's not all. You invest 500 rupees every month, and we have assumed that this 500 is never going to increase as and when your salaries are going to increase. But 5,000 rupees every month will make 40 crores by the time you retire. If you want to make 400 crores by the time you retire, you have to start investing 50,000 rupees every month. You might not be able to do it right now, but the first thing that you should start doing when you get into a good job, start saving. But who cares about retirement when you are 20? And who likes to sacrifice a trip to Goa with friends and family members, or who likes to sacrifice an iPhone that you wanted to buy? So if you are one of those who find it really difficult to sacrifice, all I would tell you is think that entrepreneurship is like investing. And like somebody has a very interesting quote for entrepreneurship, we keep on saying, even investing is living few years of your life in a way that most people will not, because sacrificing is a very tough job, very tough thing to do. Investing is living few years of your life in a way that most people will not, so that you can live a life that most people cannot. Now the last thing that I want to do is, I want to leave you with a thought that, what do you think? Is being successful, at least being financially successful, an accident, or is it a result of right education and right saving and investing habits? Thank you so much. Thank you so much for listening.